Good morning, good evening, good afternoon, depending on where you are in this world. This is Hedge Lee with a post on how to address what probably is very common, especially for novices and even for seasoned investors and traders. And that is, what do I do if I bought at the very tippy top? And I'd like to address that from a trader's perspective and an investor's perspective. From a trader's perspective, if you bought the very tippy top of this, in this case Verge, then and the price is here, then you should have already been stopped out. You should have been stopped. Let's say if you bought it here, where was your stop as a trader? You have to have the pre-spotted stop loss level and enter it. Okay? And now I'm saying if you didn't ladder in also, if you bought everything in a single transaction, okay, then I would have put a good tight stop more in this prior peak level right here. 0.0106 would have been my stop. And as a trader, if anything that went below that, it would have taken me out. Okay, I would have had a few percentage of losses, few nicks, which doesn't hurt. So that would have taken me out. And if you didn't have a stop as a trade, and you wrote it down to here because you got some hope from this, and now we are here, I think the clear mistake is you were not stopped out. So the lesson to be learned with any trade is to have a stop loss area predetermined, identified, set, and ready to take you out. From an investor perspective, it varies quite a bit from the trader because of the time frame. I think a new bull cycle for the cryptosphere is about to start. So it almost then doesn't matter whether you bought it here at this peak or at this peak or even at this peak. If your time frame is in what? Not weeks, not months, but years. Yes, while the price fluctuates from a percentage scale, your overall balance is going to fluctuate with it, up and down. From a investor perspective, a multi-year time frame, it really doesn't matter almost where you got in. Especially, let's say you were doing this, and this is very good for investment. You dollar cost average, let's say, and I will share with you Andreas Antonopoulos' most sophisticated buying strategy. And this is what he does. He buys on Mondays at 9 a.m. That is Andreas Antonopoulos' most sophisticated dollar cost averaging. And even he said if you didn't go out to dinner one night, take that 50, 80 bucks or what have you, and wait till Monday, buy the coin that you want. Dollar cost average. In that way you might buy it here, 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 some here, here. And that dollar cost averaging from an investor perspective is fantastic. And to me, that dollar cost averaging is what? Is the same as laddering for an investor class. From a trade to investor class, what you should never do is convert a trade that went bad to an investment. Why is that bad to do? You have to be then proficient in bilingual mentality, and no one really is. To be able to do that, you are breaking a very serious condition called an exception. You're making an exception for yourself. Instead of, you're almost making an excuse for yourself for trading that investment, that trade, converting that trade into an investment for your lack of a stop loss, for your embarrassment of not having been stopped out, for your, and maybe you did have a stop and you got weak and you removed the stop thinking, oh, I can't take even this 3% loss. All of those mentalities comes in as a cocktail of emotions, and no one really is proficient enough to be able to flawlessly go back and forth between a trade and an investment on the same trade. It's silly to me. So let's say you were in a trade. You didn't get stopped out. What I think would be the next best thing is sell the rallies. Next step, let's say you didn't get stopped out. You should have sold this rally, which would have been pretty close to the stop out point. So if we get another rally, I would sell the rally. What if it goes higher? Okay, it goes higher. But the difference is you're doing based on strategy and tactic, and you're not being reactive, but you're being proactive. So you're not shooting from the hips. And when you are doing a very inefficient thing of converting a trade that went bad into an investment, you're shooting from the hips. And when you shoot from the hips, what happens? You lose a lot of firing power. You're going to lose money from small losses. You're going to lose money from chasing, FOMO, fear, greed. It's going to be such a wishy-washy event that there will be total absence of process. And without a process, a strategy, set of rules to follow, it's going to be almost impossible for anyone to emotionally and mentally manage the stress to go from a trade that went bad to an investment. And if you get this value, you're going to, now in investment mode, let's say, oh, it's going to keep going up, poof, oh, you're going to get back into trader mode again. If anyone can do that, I'd love to know. Because as far as I know, no one can do that. Why? It's not human to do that. So, just as a review, you have to set a set of rules and guidelines on what to follow between a trade and an investment, and much of it depends on the time frame. Okay? And I think this video should really enable you to kind of step back a little bit, even if you're in a losing trade right now. Let's say you bought here on a trade and you're stuck at this level right now. If we get a rally, my tactic will be to exit that strategy in that rally. What if we go lower low? Well, good point. If we go lower low, well, if you're here right now, you should still do what you didn't do. Set a stop loss. Look for local support regions, like maybe right here. That could be a good stop. So anything below, going lower than that, I'm out. And you should never take the pain and dwell on the pain of this percentage loss. It can always be recovered in the next few trades. I hope you found this to be helpful. Have a great day.